So the question then becomes, where do we store this private reserve? And where do we store our liquid capital? Kind of the same question that we started this conversation with today. As we already addressed, the lack of return, the lack of liquidity, or the exposure to risk disqualifies many different types of storage tanks that we could use for this money. Let's just take a look at what the liquidity and risk level would be of many of these types of assets. If we had a savings account, that's going to earn you about 1/4 of a percentage point of interest, if we're being generous. A CD, maybe 0.5% of interest. So we turn to securities. Those are going to earn maybe a higher rate of return. Maybe we're going to get a 5% rate of return. However, if we look at specially designed whole life insurance, we're able to earn a positive return and be in a low risk and liquid environment. Here's how it would graph out on this graph. Savings would fall in a low risk and liquid environment. That's why people use savings. They want money that they can get to right away. If you put your money in a CD, you might get a higher interest rate, but it's less liquid and you can't use it. So then we look at, what if we invest that money? We're trying to get a higher interest rate, but we're also not as liquid as cash. So when we look at specially designed life insurance, we are looking at an alternative to storing cash in savings accounts and checking accounts. Now, the reason for this is that it's low risk and it is also liquid, and it's earning a higher rate of return than I've seen anywhere else on cash storage. I want to clarify something really important here. It is not, specially designed life insurance is not at all an investment. This is a storage tool for storing and holding cash reserves. I want to show you how we can do that and then how we leverage against those cash reserves. This type of policy must be designed, managed, and monitored properly in order to maximize your benefits. Now, this concept is being talked about by a lot of financial professionals, called infinite banking, cash flow banking, perpetual wealth system, cash flow system, prosperity economics, wealth formula banking. And this is addressing the need for safety, liquidity, and growth, where we used to go to the bank for it, but we still want the safety, liquidity, and growth. We still go to the bank, we don't get that growth. We are looking for other tools to optimize your economy in today's current environment. So we're looking to do the same job that a bank does, just changing out the financial institution, getting a higher rate of return and no risk if it's utilized properly. Whole life insurance is not at all new. It's been around for over 150 years. Wealthy families have used this to build legacies and pass on wealth for many generations. Here's several businesses that have used cash value life insurance. Walt Disney collateralized his life insurance policy in 1953 to help fund what would become Disneyland before investors saw his vision. Foster Farms began when Max and Verta Foster borrowed against their life insurance policy to invest in an 80-acre chicken farm that would become a worldwide producer of chicken. And now it ranks the Fosters as number 179 on Forbes' list of America's richest families. J.C. Penney. James Cash Penney opened a store called the Golden Rule in 1902, and this was a retail store in Wyoming. He was able to buy out his partners and rename the store after himself. By 1929, J.C. Penney had expanded to 1,400 stores. During the Great Depression, he borrowed against his life insurance to pay for expenses, allowing him to weather the economic environment that put many of his competitors out of business. McDonald's was began by Ray Kroc. He was a milkshake salesman. He eventually franchised the McDonald Brothers operation. When he first opened the franchise, he did not take a salary during those first 8 years. He borrowed money from 2 cash value life insurance policies as well as his bank to overcome constant cash flow problems and cover salaries of key employees, as well as start an advertising campaign for Ronald McDonald mascot. Today, 36,525 restaurants in 118 countries employ over 420,000 people, and is the largest franchise in the world that could not have got off the ground had it not been for those 2 life insurance policies that were collateralized to be able to pay for it. Pampered Chef began by Doris Christopher in Chicago in her home in 1980 with $3,000 borrowed against a life insurance policy. The company was later acquired by Warren Buffett's Berkshire Hathaway Corporation in 2002, and she still serves as the company's chairman. Multi-million enterprise, it's now a multi-million enterprise with tens of thousands of consultants and millions of customers. Stanford University was very interesting. In 1891, Leland Stanford Junior University, today called Stanford University, was opened as a memorial to Leland and Jane Stanford's only son to be able to educate the children of California tuition-free. And they did not charge tuition until 1920, and they still don't if the family earns less than $125,000 a year. They were almost forced to close when Leland died during the Panic of 1893, leaving his estate tied up in probate for years during a national crisis with hundreds of bank failures. Jane received a check for $10,000, which was from his life insurance policy death benefit payout, and that was enough to keep the doors open and keep professors' salaries paid. Now, just taking a look at that $10,000, if we look at inflation over the last number of years from 1914 to 2015, it averages out to about 3.27% per year. That's 126 years ago. That would have been over $575,000 in today's money, those $10,000 then. So inflation makes a huge impact in the amount of what that dollar sounds like, but $10,000 from the death benefit proceeds of life insurance was enough to keep Stanford University open. So it's not just companies that use whole life insurance. Banks also own life insurance. They own billions of dollars of life insurance on their executives as a Tier 1 capital asset. So Tier 1 capital reserves are actually the bank's most important asset, and they're a key measure of the bank's strength. This chart shows that in 2008 and 2009, top banks increased their life insurance holdings, and for most, life insurance represents a higher percentage of Tier 1 assets than what it has invested in its premises, fixed assets, and other real estate, all other hard assets combined. According to the FDIC, banks are the largest purchaser of cash value life insurance in the U.S. Over 62% of banks hold BOLI, B-O-L-I, which is bank-owned life insurance. An average of 13 to 19% of Tier 1 capital assets and up to 25% are within the regulatory guidelines. Barry James Dyke, best-selling author, said the nation's largest banks consistently invest 10 to 30% of their reserves, hundreds of millions of dollars, into life insurance and annuity products, according to the FDIC. There's every reason for you to do the same. So let's talk about what life insurance is and what it does for you. So term life insurance covers you for a specific period of time, usually from 5 to 30 years, and this is death benefit only. Permanent life insurance is the type of life insurance that has cash value, and that's what we're discussing today. This covers you for as long as you live, hence the term whole. It's for your whole life. There is a savings component, which is cash value, and a death component, or death benefit, which is the part that pays out if and when you die. There's also whole, universal, and variable. I'm only going to discuss whole life insurance today, as this is the one that we use for privatized banking because of several guarantees within the policy. Whole life has guarantees in mortality charges and interest and additional dividends. Universal, by contrast, is more flexible. It's a type of permanent life insurance, but it has interest earned by short-term money rates. Mortality charges increase with age. So what can happen is within the policy, as your mortality costs go up as you age, there can be costs that eat into your cash value. Variable life insurance includes mortality charges that can be either fixed or increasing, and the savings component rate of return is determined by the stock market rate of return. So that's why we don't look at variable. That has the potential for loss, as the stock market does. Universal has a potential for higher mortality costs that eat into your cash value. But whole life insurance has a guaranteed death benefit, guaranteed cash value that never drops in value, and it has guaranteed premiums. It also has dividends that are paid out to the policyholder. So the component we're interested in maximizing is the cash value as your private reserve, a place to store liquid capital. So it's a portion of your death benefit that's the amount of capital available in the policy that's contractually guaranteed. It's kind of like building equity in your house. The home value is like your death benefit, and the more you pay down the principal of your mortgage, the more equity you build. And equity is an asset. So, why is this cash value so valuable to you? It satisfies the need for safety, liquidity, and growth. So, let's talk about how. So, it's a savings tool. It sits in that safe tank like we were talking about before. It is not an investment, it's not tied to the stock market. It's a place to store and keep capital. It's guaranteed no loss of principal, so there's no risk. It's safe from creditors, predators, and lawsuits, and safe from the government. The growth factor, it earns a competitive return. So we specially structure and design these policies for early, high cash value and a long-term competitive rate of return. When we look at dividends, dividends are paid to the policy owners of a mutual company. So we make sure that we're only working with a mutual company, that the policy owners are the true owners of the company and the number one interest that the company has in terms of generating a return. As an owner of a mutual company, you receive part of the profits, and those are paid to you as a dividend. That's added to the guaranteed cash value to get your total cash value in the policy. Any new money added into your policy sets a new floor, and the policy never drops in cash value beyond that floor ever again in the future. Now, what does this rate of return look like? It earns between 3 to 5% rate of return, net of all taxes, net of all fees, net of the cost of insurance over a 30+ year period. That's after all costs, and that amount is tax free. So it's tax free because you pay tax on your money before you pay it into the life insurance policy in terms of premium. And then when it's in the policy, it's growing, tax deferred. You're not paying taxes on the growth. And then you are also getting the death benefit paid out tax free to your heirs. It's a truly tax advantaged environment. It's also liquid, and this is one of the greatest benefits of using life insurance as a place to store cash. So it's accessible. In a mutual company, the policy owners are the company owners, as I mentioned, and you have first priority to the capital. You have a guaranteed loan option, meaning that you have any opportunity, you have access to your cash value. So say you had $100,000 of cash value, you wanted to access that. They're going to leave a little chunk at the bottom, maybe 3-4%. So say you're able to borrow about $96,000. You are able to request that from the insurance company. A simple request, no credit pull, no asking what it's being used for or whether you have the capability of paying it back. You're then able to get a check in the mail within about a week, and you are able to use that $96,000 however you desire. Now, here is the true beauty of it. You are also continuing to earn dividends and interest on the whole $100,000, even while you have a portion of that deployed in other assets. And the reason is you've not borrowed from your cash value, you've borrowed against it. So when you ask for your cash value in a check, you're actually getting a check from the life insurance company, not from your own policy. So you're able to have your money continuing to earn interest and dividends while you have it out for any use, whether that's an emergency use or an opportunity use. We're going to show you what that does to your investment returns as you use that money for investments, allowing you to essentially double dip and stack your investments and earn a return in two places at the same time. Now, we also always recommend having a plan to pay back the loan. So while there is an interest-only loan that is extended to you and it will continue to accrue interest if you do not pay it off, you do not have the balance due at any particular point in time. We do always recommend having a structured plan in place for you to hold yourself accountable to be able to pay that loan off, and a plan that you have the cash flow to do that. So this then allows you to keep your cash earning uninterrupted compounding. And when you take the loan, you're not reducing your cash value, you're just placing a lien against the cash value, using the cash value as collateral, and that lien is held until the loan is paid back. It allows you to keep your cash and finance. You're still earning interest even while you have that money out working somewhere else for you. And you pay back however, whenever you want to with unstructured payments. So because of safety and liquidity of that money, you have control. You know it's not going down in value. You know it's safe. You know that you can access it with liquidity anytime. That allows you to really have the greatest advantage on your cash. So here's how that looks. You have your cash value. Here, this is money in the safe tank. This is your compounding, growing cash value based on interest and dividends. You then have the insurance company that's like the intermediary. You go to the insurance company, you request a loan. They provide you with an interest-only loan. They place a lien against your cash value. Meanwhile, your full cash value, the whole tank, continues to earn interest and dividends. And then you pay back with unstructured payments, however, whenever you choose, to the insurance company. And as you do that, they remove the lien against that policy. I want to also point out that banks will often use cash value of life insurance as an asset that they will loan against as well. So this does not limit you to only borrowing from the life insurance company. If for any reason you could get a better interest rate by going to the bank directly, that would be a fantastic opportunity to be able to use your capital as collateral, employ the same private reserve strategy, and be able to get the best interest rate that you can find. I want to show you an example of the difference between using life insurance versus a savings account and what the end result of either of those strategies are. Because in the environment where you're using life insurance, you are keeping capital and borrowing against it, and you're getting higher rate of return than in a cash savings account. So let's take a look. So here is two people saving. One's using life insurance, one is using the bank. We're going to focus on the life insurance just for a moment. We are looking at somebody who's saving $45,000 every year for 7 years. After that, no more cash is being saved, just $45,000 per year for 7 years. The total capital of that is $315,000. Now, in the cash account over here, we are earning 1% rate of return, and we're going to also be in a tax bracket. We're going to say we're in a 33% tax bracket here. Now, on the life insurance side, this is an actual illustration that we ran for a 47-year-old man with average health. So if we zoom out from year 1 through 7, we've paid in, and now from year 7 to year 30, we've not made any more contributions. And now in year 30, we want to compare the two accounts and what they look like. We've not used either of them at all. We've just put the money in, let it sit for 23 years, and then we're looking at the end result. In the life insurance, this exact illustration ended up with a death benefit of $1,036,224. There was a cash value, which is a portion of the death benefit that was available to be able to use, of $750,558. Now, if we look at the cash side, I'm going to give this a generous 1% rate of return. Now we know that it's probably going to earn less than that, but just for the sake of illustration, I want to give that some substantiality. We also know that the cash account is taxed, where the life insurance is tax-free. On the cash side, at the end of 30 years, the account has grown to $377,269. So we already see a very significant difference, almost twice as much money, more than twice as much, available to you in the life insurance, just looking at the cash value. On top of the cash value in life insurance, we also have a death benefit. Now again, why is this the case? Because with life insurance, we're able to keep our capital and we're earning a higher rate of return and it's not taxed. The difference is that we're earning a higher rate of return on the life insurance and we are also not taxed. Those are the only two differences. Now I want to show what if we use this account? So we're going to say now in the 5th year, in year 5, we're going to make a purchase. We're going to compare what happens on both sides if we do this. On the life insurance side, we're going to borrow $100,000 and we're going to pay that back over the course of 3 years. And so I've calculated here at a 6% interest rate, that would be $37,000 410.98. That would be your repayment. You pay that back over 3 years. Now, what's happening is that on the life insurance side, because even while you have your collateral deployed, you have your capital deployed, it's being used somewhere else, you're still earning dividends and interest on that full cash value. The cash value does not become affected or reduced by using the capital. I want to make sure that that's very clear. Now, over on the cash side, what we're looking at here, we borrow the $100,000 from our account in the same year, year 5. We are going to repay that. Now, this is showing repaying at 6% interest, but in reality, I've never seen someone pay back their savings account at 6% interest. So let's just go ahead and say what would actually happen in reality. You would pay back, if you refilled that over 3 years, it would be $33,333.33 every year going back into that cash account. So at the end now of 30 years, we look out and we say, okay, what is the difference now in the cash amount, the cash value that we have, whether we use life insurance or whether we just use a savings account? In the cash value account, now we've reduced from, I think we had 377,000 before, now we're down to 375. So the difference is that you use some of your capital, you reset the compounding on that portion of capital that you used. Okay. Now, what if we repeated this cycle multiple times? What if we use our cash more than just once during this time? So let's just say, how many times could we use our cash? We could use it 9 times. And that's the maximum in terms of being able to reuse this over the span of time and be able to repay it. And so this gets us to the cash account side now is now 331,000. So we've reduced it from 377 that it had the potential to create if we never use it, never reset the compounding. Now we've reset the compounding multiple times, and now we're down to 331,000. On the life insurance side, however, we have not changed the cash value amount by using it multiple times. So you're able to use velocity of money. On the life insurance side, you're able to continue to recycle that money. Every time you pay it back, it frees up the capital to be able to use again, and you never reset the compounding. Genius. Now, the other thing that we want to take a look at is that if we were going to make these equal and we were going to say we need to get the same amount of death benefit on the cash side, what is the cost of paying for term life insurance for the same 47-year-old man to get $136,224 of death benefit? So I calculated that amount. We would need to put in $34.90 per year. So this is the annual cost of term insurance, $34.90. Now look at this number, the cash account value, $331,045. And once I add in the cost of term insurance, now that's an additional cost that went somewhere besides this cash savings account, further depleting what our cash had the potential to grow to. So now we're down to $214,000. The difference between this is over $500,000 just by using life insurance. And again, the reason for this is 3 things. 1, we never gave up our capital on the life insurance. We also are earning a higher rate of return, between 3 and 5%, and we're also in a tax-advantaged environment. I want to show you what the rate of return looks like on the life insurance if you were to achieve this cash value amount from the premiums that you put in. If we look out over putting $45,000 in for 7 years, never funding the policy again, and we looked at 30 years later in a 33% tax bracket to achieve a $750,558 cash value and a over $1 million death benefit, your cash would have had to earn 6.71% in order to keep up with the death benefit, and it would have had to earn 4.87% to keep up with the cash value. Now, what we've just discussed is just the internal rate of return on the life insurance itself. If you never used it for anything else, we're only looking at the specific rate of return just on the life insurance if you used it as a tool of accumulation. However, we're actually wanting to use life insurance as a tool for cash flow generation so that we can use our money. And I want to show you what it looks like if we obtain and earn money in two places at the same time, because we're talking about the life insurance side. I want to show you when we add in the returns on the investment side that you might be borrowing against the life insurance policy for investing into. So when we use specially designed whole life insurance plus the private reserve strategy of keeping your capital, borrowing against it, and then paying yourself back, never giving up your own cash, that is privatized banking. Here's what that looks like. You have your premium that's going into the specially designed life insurance. The cash value is growing, and you see interest and dividends out to the side that continue to be earned whether or not you use your cash. If you take your cash value and you borrow against it, this is taking a life insurance loan, and you deploy that capital into an outside investment. Maybe this is real estate, or maybe it's your business. And that investment generates its own cash flow in return. You are able to then pay back your life insurance loan with that capital and then be able to free up the capital to use again. What you're doing is you're earning compound interest on your life insurance cash value. You're paying back the life insurance loan with simple interest. This is privatized banking. I want to talk to you about a couple of the attributes of privatized banking that make a life insurance policy work most efficiently and effectively for you. So one is that there are multiple types of premium that go into a life insurance policy. Base premium provides the greatest amount of death benefit. Paid up additions provide less benefit dollar for dollar, but provide more cash value. So comparatively, base gives a great death benefit and little cash value. Paid up additions give a small death benefit and more cash value. Now, when it comes to the commission paid to the agent who sold you a life insurance policy like this, base premium pays a greater commission. So many life insurance agents are not willing to cut down their commissions to the point where it actually benefits you to increase your cash value up front early. So it's more advantageous to you to have higher paid up additions because you have more of that cash immediately accessible to you. You can do this up to the limit, which is called the MEC limit, modified endowment contract. If you put too much paid up additions or you overfund the policy too much, it then ends up losing its tax advantage and it may as well be taxed just like an IRA. We don't want to do that. We still want to make sure it's tax deferred growth. We don't pay tax on the growth. We want to make sure that it's also tax-free at distribution when it pays out to our heirs. So many times I hear people say, well, life insurance takes 15, 20 years to accumulate cash value and I can't borrow against it. I can't do anything with the cash until that point. And those are some of the reasons why. So a specially designed whole life insurance contract is one that has maximum paid up additions riders, makes sure that you are increasing your cash value upfront and early. So when you use your cash in the life insurance policy where it's earning dividends and interest, and you also deploy it into an outside investment, you're essentially stacking your investments and you're getting your money to double dip, earning a rate of return in two places at the same time. This is really getting your money to multitask. It's not just going to the life insurance and sitting there to accumulate. It is being used specifically to flow through the life insurance policy so that it can be used in multiple places at the same time, getting you to have the maximum advantage on your money. The other thing that I want to mention is many people ask, how quickly is this cash available to me once I've paid my premium? In most cases, as soon as the check clears the insurance company, you can request a loan. Once you do so, the insurance company sends you a check which you'll receive within a couple of days to a week afterwards. Let's talk real briefly about capitalization. So this is how much of your cash that you've put into the policy is available to you in each year. So in year one, you have about 50 to 60% of your cash available. So say it was $100,000 a month premium or a year premium that went in. The first year, you're going to have access to about $50,000 to $60,000. Year two, $60,000 to $65,000. Usually by year 5 to 7, we are seeing 100% of your paid in capital available to you in cash value. Meaning that in year 5, if you've paid in $500,000, you have close to $500,000 in cash value that you can then use. So again, I want to help you think about this in terms of how quickly you're putting money into the policy and then being able to take it right back out and use it somewhere else while it's still earning dividends and interest. Now, here is an example. If you were able to take $100,000 of cash value from the life insurance and use it for purchasing an investment property that would cash flow $1,000 every month. I want to compare for you the difference between paying cash only and what those returns look like versus using permanent life insurance as a private reserve, and you have that double stacking effect of the insurance and the investment. So let's look at using life insurance first on the left-hand side. With life insurance, let's say that you take a policy loan at 5% for 30 years. Your plan to repay this loan is a 30-year payback schedule. This is, again, your own plan. The insurance company is not going to hold you accountable to it. You want to hold yourself accountable. You take out the $100,000 policy loan, and that is going to be due back with simple interest to the life insurance company. So your monthly cash flow from the property was $1,000 of monthly cash flow. We're going to have to reduce that by the amount we're paying back to the policy loan. So $1,000 coming off the property minus $536 that we're paying back to the life insurance to cover the policy loan is $463 per month that you get to keep and hold. Okay? The total cash flow over 30 years, if you take that 463 times 12 months in a year times 30 years, is $166,744.80. So that is our total cash flow over those 30 years on that rental property. Now, I also want to take a look at what is my policy cash value at year 37. And the reason for year 37 is that I want to take a look at what happens 30 years after the purchase of the property. So we took the loan in year 7 from the life insurance policy. 30 years from that point, my policy cash value is now $951,832. And if I add that to the total cash flow I received from the property, I have $1.1 million and then some. Okay? $1.118576.80. If I instead look over at the cash account side, here's what I am able to accomplish. I had put the same $45,000 in every year for 7 years. I was earning 1% rate of return minus the 33 tax bracket. So that is an adjusted 0.67% rate of return. So 1% minus 33% tax bracket. Just want you to see where the math is coming from. So in the year of my purchase, my cash account was a total of $323,556.08. I drained the tank by $100 or $100,000. My new balance in year 7 is $223,556.08. I then take my monthly cash flow, which is all available for me, and I don't have to pay back any loans. That $1,000 a month of rental income means the total cash flow from the property over those 30 years is $1,000 times 12 months per year times 30 years. That ends up at $360,000. I'm able to use that every month to replenish and add to my cash account. So then when I look at that starting balance of the $223,556.08 in year 7, adding $1,000 a month, earning that same rate of return, 0.67%, my total cash account balance in year 37 is going to be $671,623.99. So what I've done is I've looked at systematically the difference between putting in $45,000 a year for 7 years, no more contributions, and then being able to use that cash for a cash flowing investment. And the end result is $446,952.81 more cash that I have to work with if I use life insurance. And that's if I only use the policy loan one time in that whole 30-year span. And so as I'm able to keep my cash in my control, even if I have to pay interest, even if I have a liability, even if I'm paying back a loan, for goodness sakes, I have debt. It's not true debt, but many people would say, well, I can't do that because I don't want to take out debt. We're using leverage to keep our cash in the life insurance and to finance at the same time, allowing us to have this tremendous accelerated benefit from having more cash in the long run. I want to take this one step further because if you were making this return in your property with the life insurance policy, so even after you're paying back the policy loan, what could you do with that $463.18 per month? You could, instead of just keeping that cash and having no rate of return applied to that portion that you're taking as cash flow, you could start a second life insurance policy with that cash. So if we took $463.18 over the course of those same 30 years and we put that into a life insurance policy, apply the same rate of return, that 3.26 that we were getting in the other policy, and we look at what would happen if we fast forward out 30 additional years. So the second policy is in force for 30 years, ending in year 37 of our example here. That secondary policy would now have cash value of $280,000, $703.14 at the end of that time frame. So if we look at that plus the cash value that's available in the first policy, we add together a total cash value available in the two different policies of $1,232,535.14. If we compare that over to what was happening on the paying cash side, if we just use cash only, you would have had a cash amount available to you of $671,623.99. Now, in either case, if we wanted to look at the total profit, we would need to go ahead and subtract out the purchase price of the property, the $100,000 that we initially used to purchase the investment property. Doing so, on the life insurance side, we now end up with a total profit of $1.1 million. And on the cash side, we have a total profit of $571,000. What is that difference if we look at the overall change or the additional growth that we were getting? We're actually getting 98% more profit in the long run by using life insurance to purchase the exact same property and have the exact same cash flows from that property. So this is an additional way to leverage your cash to increase your returns. So that's the power of using cash value life insurance as an and asset. Many times people think that they have to either put their money in life insurance as a place to store cash only or invest the money. I want to let you really clearly understand today that we are advocating using both, not just one. You don't have to pick one. This isn't multiple choice. This is C, all of the above. So the power of specially designed life insurance is to use it as an and asset, using life insurance and an investment flowing through the life insurance to the investment, from the investment flowing through to pay back a policy loan or to even make premium payments to begin with. It could even be the other way around. It could be the cash flowing investment first to pay the life insurance premium and then building up cash value and having the cash value be something that you borrow against for additional investments. We want our money to flow through the assets though, not just to them and sit stagnant waiting for retirement. Now, we talked at the beginning of this video series about passive income and how the objective is to really get your assets producing income and not just living off of your income from your job. And so I want to be really clear here. As we're talking about cash value life insurance, this is not the asset that produces income for you. But what it does do is it is an amplifier of your cash flowing assets. I want to walk you through the financial statements with your income statement and your balance sheet to show you how this looks in terms of your cash flow and your net worth and the changes that happen as you use life insurance. So first of all, we're going to go ahead and start out with the $200,000 of cash value life insurance. This is an asset. It is on your balance sheet. It's not at this time producing cash flow. What this does is that it provides you $200,000 of net worth and has no change in your cash flow. Next, we're going to move forward and we're going to add a liability as well as an asset. We're going to take a loan against the life insurance cash value. We're going to borrow against that policy taking out a loan, which is on the liability side for $100,000, and we're going to use that loan and the borrowed capital to purchase a $100,000 rental real estate property. Now, this property is going to be a $100,000 asset sitting on the asset side of your balance sheet. The rental real estate then is going to produce an income for you. So we're going to use the same $100,000 per month that we used in the previous example. This $100,000 is your positive cash flow. Now, we do need to remember that there is going to be an expense associated with that loan, and you want to pay that back to the life insurance policy. Now, again, this is flexible. So if you set your own guideline and you said, I want to pay this loan back over 30 years at 5% interest, you can do that. And that was the number that we worked out earlier, which is $536.82 per month. Now, instead of making that fixed payment every month, if you had a greater need for cash flow today and you needed to shrink those payments so that you could have more of your cash flow available to use in your personal life, you could absolutely do that. And if you wanted to go the other direction, you want to pay that loan off as quickly as possible and put possibly even the full $1,000 back into the policy every single month, you would absolutely be able to do that as well. So it depends on what objective you're trying to accomplish. Are you trying to use this for living expenses now today? Or are you trying to put the money back into the policy quickly so that you can then again turn around and recycle that cash flow or recycle that cash value in the policy, possibly to purchase an additional asset or direct money back into your business that is going to then produce you an additional income in the future. So if we just paid the loan back at that consistent flat rate, what would that do to our cash flow and our net worth? So our net worth has actually stayed exactly the same when we first purchased that property because we added a negative $100,000, which was the liability for the life insurance loan. We've also added a positive $100,000, which is the asset of the property itself. And our cash flow then is a positive $463.18 per month. Now, once we pay off that loan, we then have removed not only the expense of paying back the life insurance loan, we've also removed the liability of the loan itself. What financial position does this put you in? Now, after the life insurance loan is paid off, you now have a net worth that is increased. So you have the life insurance cash value of $200,000 plus the rental property of $100,000. Now, I'm using simple numbers here, and I do want to also articulate that we know the cash value is growing. That value, as you pay off the loan and you've extended the time horizon, you're further out into the future, not only will the cash value be increased over and above that $200,000 mark that you started at, but also the rental property is likely to have appreciated in value as well. So it's very possible you would have an added amount of net worth, but I want to just leave the numbers simple for this illustration. Your cash flow at this point is a positive $1,000 per month. So I want to make a couple points about this. One is that when you use a life insurance loan to purchase an asset, your net worth is not going down. It's staying equal. When you focus on cash flow, net worth is a result of that. So if you focus on building assets that cash flow, your net worth will automatically rise. But if you just focus on net worth, you will not get into the position of being able to accelerate your financial freedom through passive income. Another point is that money is meant to be flowing through assets. So life insurance is a key tool to be able to use to flow your money through this asset and be able to use it. Because again, your cash value in the life insurance policy is meant to be used, not just as a tool of accumulation. If we just left that money sitting in the life insurance and never used it to purchase a property, we would never have created that cash flow stream from the rental real estate. This is also only showing the money being used one time for only one property during the course of those 30 years, where you could have possibly put the money back much more quickly into the policy, reused it, and used this same policy for many property purchases instead of just one. Additionally, if you're a savvy real estate investor, you recognize that you don't always have to use all of your own capital to put into a property, and you can accelerate your returns through the use of leverage. So you might not be you may not pay cash fully for the property as we've illustrated here. Maybe you're taking a down payment from your life insurance policy and you are getting bank financing for the remainder. Or maybe you're using investor capital, both to increase and boost your cash on cash returns. So I want to recap why using privatized banking is better than paying cash. First, you're getting a higher tax-free rate of return on your capital. You're also getting the ability to use your money with a guaranteed loan option and non-structured repayment of loans. You have the cash value that continues to compound even while you're using it in a loan from the life insurance company to earn a return in another investment. You get to stack your investments. You're essentially double dipping, and your cash value is doing two jobs at the same time. It's earning interest in dividends, and it's also buying cash flowing real estate investment. You're leveraging and paying back loans with simple interest while your money continues to compound at compound interest.